When preparing to make any big purchase, particularly a home, it's important to have a good understanding of your credit. In this video, we'll talk about what exactly goes into your credit report. First, it's important to know what's on your credit report. You can check your credit for free at annualcreditreport.com and dispute any inaccurate information or accounts if needed. Throughout this process, it's important to pace yourself and remember that building good credit takes time. Let's talk about what your credit score means. Most home loan lenders will look at your FICO score. Your FICO score is a combined assessment of your credit worthiness across the three major credit bureaus: Experian, Equifax, and TransUnion. This score will affect whether or not a bank will allow you to borrow money and your loan interest rate. Having a low credit score and a high interest rate can cost you thousands over the term of your loan. So it's important to get your score as high as possible prior to approaching lenders. Your score is made up of several factors, including payment history, amount owed, the length of your credit history, credit mix, and new credit, each weighed differently. Taking these factors into account, you'll be assigned a score between 300 and 850. A score below 640 is considered poor or high risk to lenders. 640 to 720 is considered a good credit score, and above 750 is considered excellent. Payment history is the most important factor in your credit score. Lenders want to know that they can trust you to make on-time payments and pay more than the minimum when possible. The easiest way to keep your credit in good standing is to make consistent payments. The next largest component of your credit score is your credit utilization, or the amount you owe relative to your credit limits. A good goal for credit utilization is to keep your trade lines, specifically credit cards, below 30%. For example, if you have a credit card with a $1,000 credit limit, you don't want to carry a balance of more than $300 from month to month. Lenders also want to know how much experience you have managing your credit, or the length of your credit history. This is measured by your oldest open and active trade line account. Be mindful of closing accounts that show you've been managing credit for a while. Even if you carry no balance on an open account, closing it could mean that your credit history appears shorter, which could negatively affect your score. Your credit mix shows lenders what kinds of lending products you have experience with and the types of credit you manage. Ideally, you'll have a combination of revolving debt like credit cards and installment loans like student or auto loans. The final factor in your credit score is new credit. This refers to how often you request new lines of credit and how many hard inquiries are on your credit report. A hard inquiry is when you request a credit pull for a new line of credit or loan. This can happen when you apply for an auto loan or when you sign up for a credit card at a store checkout. Make sure you understand how this can impact your credit before you agree to sign up for anything. You do not want to have more than 2 hard inquiries on your credit report. Hard inquiries stay on your credit report for 2 years, and more than 2 will decrease your score and show lenders that you rely on money you don't have. During the home buying process, you will rack up 2 inquiries. First, at the pre-approval and again at closing. This is why it is very important that you put a freeze on borrowing money as you enter the home ownership process. Next, we'll look at strategies for building and repairing credit as you prepare to purchase a home.